What if I told you there was a way that you can have capital gains and not pay any tax? In other words, you can have income, but the tax on it is zero. That would be interesting to a lot of people. And so that's what we're going to be talking about today, how you can have no tax in retirement on gains. Not all income is equal, and some is tax-free. And we're going to talk to Tony Shore about this. Tony, we're talking taxes. It's tax season. So we're going to talk about it, and I want to go through this with you. We've done a show on this before we went on video, before people got to see your sweat coming down when we start talking numbers.
Oh, yeah. I've never been able to properly explain myself in the video format, Dan. Let me just tell you that, first of all. But interesting, not all income is equal.
Right.
Yeah, we hear the word equal and equality a lot, but I never in regard to income. So
that's right.
That's unless it's talking about what men make versus what women make. We hear a lot about inequality in income that way.
Well, we talk about Roth versus IRA traditional.
True.
And so there's tax-free there, but that's not what we're talking about today. We're talking about gains on long-term versus short-term. There's another one. So not all income is equal. That means that ordinary income is different than dividend income, which is different than capital gain income, which is different than rental income and so forth. So not all, and Social Security income. So not all income is treated the same tax-wise.
So if you make money when you inherit something, is that capital gains?
Yes, but we'll get to that in a moment. How much of it is a gain versus how much is it inherited? What's your cost basis? That's the question there. Yeah. But let's talk about investment income because that's what we're going to be talking about today.
Sounds good.
Investment income is income you create or you've generated from an investment in something that you've put money down toward, you purchased, and then you have a sale. The difference is the gain. So if you bought something for $10 and you sold it for $30, you have a $20 gain. And who likes gains? Everybody likes gains, including Uncle Sam. And Uncle Sam says, you owe us tax on the gain. Okay? But there's a big difference between how much you owe in taxes on an investment gain versus ordinary income. And the big differentiator is how long did you own that investment? So if you've owned it for long-term versus short-term, the tax rate is different. So what is a short-term versus long-term?
Yeah, where are the cutoffs? And does this include interest on my 401k and IRAs? Is that considered gains?
No. If you have a gain in your 401k, you bought Apple at $10 and you sold it for $100, that's a gain. But because it's within a 401k, all of it's taxable anyway.
Yeah, it's all taxable as at regular income tax rates, right? You don't get the capital gains.
Mm-hmm.
So if it's not within the account and I own Apple
in an
stock,
IRA, if it's not in an IRA or 401k.
So if it's not in a tax designated retirement account like an IRA or 401k, and I own Apple stock and it goes up over the next year, so I sell, and let's say I make $2,000 profit, is that capital gains then?
Yes, that would be a capital gains, and depending on how long you held it for, would be short-term versus long-term. And now the year is cut off. The 1 year is a cutoff. So if you bought Apple and sold it 3 months later or 3 days later, that's a short-term capital gains, and that is taxed as ordinary income, as if you were working at Apple and got paid.
So people trying to time the market or play the markets have to pay that short-term gain.
Yes, short-term capital gains, anything held for less than a year. Now, of course, if you're a day trader, that could be your profession, and that's a little different. But we're talking about for the average retiree, if you hold something for longer than a year, then it's long-term capital gains, and that's taxed differently than short-term capital gains.
Short-term capital gains are taxed usually they're less tax rate than regular income tax rates, right?
They are two different tax brackets, and I'm going to go through those, and that's how a retiree or anybody can pay no tax on a gain. If they have a gain and they've held it for longer than a year, it's a long-term capital gain. And then they are in a capital gains tax bracket. And here they are. Federal tax bracket on long-term capital gains is 0, 15, or 20%.
Wow.
Depending on your taxable income. So, getting back to your example, you sold Apple stock and you made $2,000 profit. You sold it for $2,000 more than you bought it for.
Right.
That would be a capital gain. And let's say you held it for longer than a year. That would be a long-term capital gain. And which capital gain tax bracket, or which were you going to be paying on? Well, 0, 15, or 20 depends on your taxable income. Well, what is taxable income? Let's take a step back. Now, again, I want to, what, now's a perfect time. Let me see if I can find him. Let me see if I can find my son John to come in here and just make a quick statement.
Dolphin Financial Group does not provide tax advice. See a CPA for tax advice.
Did I get an alligator in that pond?
It is. In fact, this past weekend, I was planting some water plants in the pond. A little alligator. I saw an alligator eat a duck. I witnessed the whole thing.
Wow.
Right off the land. It was crazy.
Florida. What are we going to do, man?
So going back to taxable income. What is taxable income? Taxable income is, for lack, just to keep it simple, adjusted gross income, or AGI. So all of your income that you bring in, minus what you might put into retirement accounts, minus your deduction. And for most people, it's a standard deduction. So if you have income and you put some into retirement, that comes off your income, and then you take the standard deduction, we'll call it $24,000 for a married couple, something along, or $27,000 for a married couple, just went up. That's your taxable income. They look at that and say, okay, now we're going to see how much to tax your capital gains. Keep in mind, the actual capital gain, so the $2,000 you made selling Apple, that's considered part of your adjusted gross income. So you have wages over here, and then you have some interest from the bank, which are finally paying interest, and then you have a capital gain that gets lumped into your adjusted gross income. Okay? So still, your wages are taxed differently than the capital gain. So you could be paying different tax rates on different income in the same calendar year. So the question is, how do I pay 0 on my capital gains?
Yeah, I saw that. Everybody's looking at that first category. You said you either pay 0, 15, or 20%. And I'm like, I'll take the 0, please.
Take the 0, please. Yeah. How do you get the 0, Tony? Here it is.
How do we get it?
For a married couple, long-term capital gains in 2023, less than $89,250 of taxable income.
So you just need to be a radio show co-host to get that 0%. That's what you're saying.
Think about it. This is above the average wage for a family, and you got the standard deduction. You could be well over 100,000. Take the standard deduction as a married couple, and still pay no capital gains tax.
Okay.
So in your case, let's say you and your wife made 100,000 total, and you take the standard deduction. So now you're in the 70,000s for taxable income. If you sold that stock, Apple stock, for $2,000, you would pay 0 tax on it. You'd still pay tax on your income, ordinary income, but for that $2,000, there it is, 0 tax. This is significant. People don't realize this, and they should understand that capital gains tax is different than ordinary income tax.
Right. Capital gains is when you sell something and make a profit.
That's right. When you sell something for a profit, you have capital gains. Long-term capital gains is taxed differently than ordinary income. So it's important to note. Now, that's the 0% tax bracket. What's the 15% tax bracket? 15% tax bracket is 89,000 up to 553,000.
Okay.
And then above 553,000 is 20%.
So only guys like you have to worry about the 20%. The rest of us are probably in the 0 to 15 is what you're saying.
We're co-hosts. We're what I'm saying? Like, two of us. We're in the same bracket, Tony.
No, the host is up here. The co-host. Yeah.
I will say this. think about this. Anyone making over $550,000 is at a high tax bracket for their ordinary income, right? They're at the top tax bracket, which is like 43%.
Yeah.
So they'd be gladly paying 20% on a capital gain.
Oh, yeah.
Right?
Yeah.
The capital gains tax bracket is a lot lower than ordinary income tax bracket.
Yeah.
So you want capital gains. And for the average retiree, they're not showing $89,000 of taxable income.
Right.
So, but they might be sitting on a gain from a stock they've owned for years, not wanting to pay tax on it, when they would be able to realize that gain and pay 0% tax. But they're afraid to sell it for the tax purposes, but they don't realize they wouldn't have a tax. So they don't sell it.
Right.
And when I meet people like that, I say, "Oh, you got that stock? Oh, I bought that years ago. I bought Apple at IPO." Right? No, I don't run into anyone that did that, but I bought, I bought Tesla, right? I bought Tesla when it first came out, and look what happened. I'm up 5,000%. Okay, I don't want to pay capital gains on that. Well, how much did you make? I'm up over $12,000.
Wow.
Well, your taxable income is only 60. Why not just sell it and get that extra 12,000? Well, I don't want to pay tax on it. You would pay 0 tax on that.
Wow.
So people don't realize that. I think it's important for people to know. And I've talked about this before, but it gets lost. So I do want to talk about a few tips, a few considerations before we close out, though, because it sounds great, right? Too good to be true. It is. I think the capital gains tax rates will be changed. So keep that in mind. But right now, they're very favorable.
Yeah.
First thing you got to know, tip number 1, is you got to understand the tax basis. So your first question to me was, well, what if you inherit that second home from your mom? Or maybe your mom bought AT&T stock years ago and you're inheriting it. What is the cost basis? This is important to know. When you sell a stock or a house, some sort of investment, that's the sale price. They care about what the cost basis is, or basically the purchase price. But if you inherit it from your mom, the cost basis jumps all the way up to the day she died. So if your mom left you Apple stock that she got at IPO and she died this year, you would inherit it as if you just bought it the day she died. You wouldn't pay tax on all the gains that she had when she was alive. Important to know. That's called the cost basis. Understanding that basis is really important when it comes to capital gains.
So inherited things like cash, stock, property, that taxed under the same capital gains tax law?
No, it's
An
called
inheritance tax.
That's different. That's an estate tax. That's different.
Estate tax. That's right. Yeah.
And those are extremely high at the federal level, 12 million per person. So we're talking about, the key term is a step up in basis is what you hear.
Yeah.
When you inherit a house, say a cabin in Minnesota, and your mom leaves it to you, the IRS is going to be like, "Oh, well, let's pay tax on that." You get the cabin at the basis stepped up to the day your mom died. Now, if you sell that in 6 months, 6 years, and you've made a profit since your mom died, then that would be a capital gain that you pay tax on. But if you sell it immediately, no tax, because you inherited it, got stepped up. It's a way to avoid taxes. Capital gains tax is by leaving it as an inheritance. It's important to know. Not every asset does that.
Sure.
But we've done shows on estate planning. I'll put them up here. Very good to know that. Okay. Another very key point is Social Security strategies impact your taxable income. Remember, we've done shows. I'll put all the shows on Social Security up here. It's important to note that not all of Social Security is taxable. At least 15% is tax-free, but for many people, they don't pay any tax on Social Security. So now bring in capital gains.
Okay.
Capital gains can impact what percentage of your Social Security is taxable. So you could go from saying, oh, I'm not going to pay any capital gains tax because I'm below the threshold. Me and my wife make less than 89,000 of taxable income. We're going to sell that property and make 10 grand. We're still going to be below 0% tax. But now all of a sudden, your provisional income, which had it, I'll put the show up here on that, had a Social Security taxed, you might be raising your provisional income. So now all of a sudden you're paying tax on Social Security when you weren't before you sold that second home.
And people say, a lot of people don't realize, I know you've talked about it in past shows, that Social Security is taxable. Up to 85% of your Social Security can be subject to some type of tax, right?
Right.
Isn't that correct?
And how much is depending upon your provisional income, which is its own formula, and capital gains add to your provisional income.
And what state you live in with Social Security tax, because some states tax
Some states tax it too.
as
Florida
well as
does
the
not,
federal.
though, Tony. Ding,
Right.
ding, 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 ding.
Yep.
So very important to know that capital gains decisions can impact Social Security, and Social Security decisions can impact your income. So very important.
Do you think if Social Security, if Florida started to implement some state taxes, like on Social Security, they'd have enough money to take care of red tide and alligators?
Moving on. How's the weather up there, Tony? We're approaching April. That should be when the snow starts to melt, maybe.
I wish I could switch my camera and show you the view of the foot of snow. Yeah, I'm up here in Minnesota. You're down there in God's country. I'm just teasing you about the red tide. Had to poke that bear, didn't I?
Yeah.
Or in this case, that gator. Yeah.
You know, whether or not we have taxes is not going to impact red tide. I will say that. So I take no tax. Okay. Last tip. Don't forget about Irma. Now, for the Floridians, I'm not talking about Hurricane Irma that destroyed the west coast of
or your
Florida.
aunt who always brought over the Aunt Irma,
Right.
who always brought the fruitcake. Yeah.
This is a Medicare adjustment. It's called the integrated Medicare adjustment, monthly adjustment amount.
We did a show on that.
Yep. I'll put it up here for those that haven't seen it on Irma. Yep. Right above Tony said. So if you are paying for Medicare, it's a standard rate. However, your income may bump you to the next Medicare tax bracket or cost. So everyone pays 160 something until you make above a certain amount. Then your Medicare Part B premium goes up. Capital gains can impact that. So if you want to sell something and pay 0% tax, realize that eventually that tax bracket's going to maybe put you into the 10% of the 15% capital gains tax bracket, which would also potentially increase your Medicare that year. So keep that in mind. This happens to a lot of people that move to Florida. They sell their home or their property or investments to buy the new house. And all of a sudden, Social Security sends them a letter and says, hey, you made a ton of income 2 years ago. Your Medicare premiums are going up. And then that's a different topic, but just keep that in mind.
So you have to strategize around that, and that's something you help your clients do and can help our listeners with. If they have questions about that, I know that you're going to put the phone number up eventually here, and they can call you and set up a complimentary consultation, no cost, if they need information on this and need a plan. That's what you do, is strategize to minimize that tax burden. Make sure you're not making costly mistakes, like something that would cost your Medicare or the government to look at it and say, hey, you made all this money, right?
Yeah. And sometimes you that's part of the planning. Okay, if we do this, your Medicare premium is going to go up for a year, but think about this. Oh, we're going to do a Roth conversion. There's a lot of tax issues that happen, and capital gains is a big one that people don't understand. But the tax code favors long-term capital gains. So just knowing that, you can make a lot of money, but there's every time you move one lever, something else happens. So you need to be looking at the big picture, which is why you don't prep your taxes. That's what accountants do. You give them the numbers and they tell you how much you owe or how much you're going to get as a refund. Before you do that, you need to plan and you need to think about, okay, should we sell part of this as a capital gain this year? What about Irma? What about long-term? Is it a short-term, long-term? What about Social Security taxes? All of that is planning. Before you actually make the sale, you have an intelligent planning discussion about taxes. And that's what I do. Because I'm a certified financial planner, one of the key components of financial planning is taxes. Because it infiltrates every aspect of financial planning. So when you're making decisions with whoever you're dealing with for your finances, if you're doing it on your own, you got to go see someone that knows taxes.
Yeah.
If you're dealing with someone investment wise and you ask them about tax questions and their response is, "Oh, I don't know. I don't." Talk to someone else about it. Time to either talk to someone else about it, take them up on it, or talk to a certified financial planner who's legally obligated to look in your best interest and understand the impact of taxes. This is not something that you should take lightly. At the same time, it's not something that you want to avoid, because you can really make out like a bandit and not pay any taxes on capital gains. You just got to know it. That's my soapbox, Tony. I'll get a little crazy about
You got on it. You got on that soapbox.
Yeah.
And that's good, though. I mean, it is really important. People just don't understand all the strategizing that can go into this to minimize a tax burden or not make a costly mistake. When it comes to taxes, it's crazy. And you need to work alongside a financial professional like yourself who looks at the big picture along with your CPA or other tax professionals. So how can our listeners out there get a hold of you to talk about this or get a plan in place?
I'm going to put the number up in a minute, but keep in mind that, you got to be strategic about capital gains and say, hey, maybe I'll sell a little bit this year and a little bit next year, and just don't do an all or nothing. Think about it. Do the math. So the easiest way to get in touch with me, go to dolphinfinancialgroup.com or give us a call at the 888-508-5935. I'll put the number up here next. Tony, thanks for a good show. We'll catch you all next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.